what we do is essentially we look at a very short this thing saying, so the topic that was given was economic rationale behind the prolonged decoupling of real economy with its indicators. So what do we mean by firstly real economy and indicators? And I think good thing was the one who introduced me has already kind of pointed indicators are not necessarily the current indicator, because you would agree that as an economist, you would agree that one would say that there is no decoupling. For example, indicators like, let's say, agriculture output or industrial growth or employment or GST revenues, the credit growth figures from the banking, that is central bank, or the cement production figures. These are real indicators. So while that be the case, informal sector estimates that it is about 50% of GDP. What we are trying to say is that, in other words, what we are trying to say is there are two types of indicators. One, of course, are economic indicators, and another probably are other indicators such as stock market. And we are essentially trying to say within economic indicators, we are trying to say that most of the indicators are real. Yes, it is a fact that informal sector to an extent has there are estimates that they constitute 50% of the GDP. And one can probably say that perhaps they are imperfectly measured. That is, one can always kind of go ahead and question the way they are being done, but maybe one can say that they are being imperfectly measured. On the other hand, one can also say that, look here, there are indicators such as, let's say, Google's mobility, modern day indicators, which probably have not been thought through by the one who computes the GDP, such as Google mobility, or let's say the fintech transactions that take place out there, or the transactions which perhaps involves an amount of crypto linkage. Such indicators may not be getting captured even within the real economy indicators. So given that the topic has been given to someone who has never kind of done much in economics, and we presume that the discussion is essentially largely going to be on stock market indicators. Now, when it comes to stock market indicators, what are the kind of two indicators which we come across? If one goes to an RBI website, if we presume that the interaction be kind of to start with be limited to only country context such as India, if one goes to RBI website, there we essentially have only two indicators. One is BSE Sensex, and the other is, of course, NSE Nifty. And if you would agree that perhaps they capture only a portion, and they capture only the equity part of it, and they also, to a certain extent, one can always say that there are issues in the way the constituents are being picked up, described, etc., etc. The other part is, while the other economic indicators were more of present indicators, the equity indicators, which is the barometer which makes the, you can say, channels such as CNBC and G Business happy and sad, are essentially present value of future cash flows, not just today itself. So in that sense, there is a certain amount of, one can always say that there is a certain amount of, the focus is on residual benefits, and residual benefits of from whose perspective? Only from the perspective of equity owners, none other persons. And also we may also say that there is, of course, a fair amount of, given that it is future earnings as well, and there is also a certain discounting factor attached to it, there is a large scale estimation involved in it, and there is also certain amount of uncertainty which is there and which essentially leads to the day-to-day ticker tape going up and down. In other words, what are they possibly missing? They are definitely missing a huge chunk of what we call as one big investor out there, that is the debt. And why are the debt indicators missing on the RBI website? Perhaps India is dependent more on private debt. And in other words, banks largely give and take loans, banks and institutions. Public debt, that is essentially listed debentures and such aspects, are relatively speaking, have not taken off in India. Now, what could be the reasons behind it? The reasons are possibly, we can always say, as an economy, India has a large tradition of entrepreneurship, wherein we've got the trading community of spices, which used to trade for over 400 to 500 years with the Middle East and other places, and we have history of those kind of transactions. And in that sense, the relatively speaking, the wiring of the nation is relatively more open to risk-taking instruments such as equity. And also the fact does remain that debt, or to be specific, public debt has never taken off, even though there has been enough number of times the government has tried to do pump priming, but it has never taken off, and that also remains a certain issue out there. Then we also observe that one can also say that, look here, there are a few other categories of ownerships and a few other parts of the economy that are missing. So these are a few things which we need to take into account, and these in some sense are the initial ingredients of why decoupling is happening. What we are trying to say is stock market indicators definitely are capturing only one perspective, and that too they are being measured and rated, ranked and primed largely by one segment only, and they are missing the other aspects which probably are also needed to do any business or any kind of commerce, the system that is there. Now, there are, of course, other issues ensuing decoupling, and maybe I'll kind of elaborate a little bit on them. But what we are essentially saying is there are organization continuum issues as well. What are we trying to say? That if we observe, earlier there used to be only one or two types of organizations, or max to max three types. Now we have sole proprietorships, one-person company, LLPs. Then, of course, you got partnerships also. Then you got private limited companies. Then you got public limited companies. And then you have the guaranteed companies and aspects of this. And to a large extent, the barometers that we picked up just now are to a certain extent focused on only this part of the organization continuum. And these are, we are talking only from the perspective of for-profit organizations. A fair portion of these decoupling is also because the economy has a large chunk of business being done, which are also by non-profit or not-for-profit organizations, such as, let's say, the cooperatives. Then the other part I would like to focus on, which is something which I would say the existing literature perhaps has not given a thought through, is what we call as the taking on the transaction cost economics, wherein cost said, look, transactions happen because by, let's say, organizations, or by, you can say, units such as business entities, because you are bringing a certain amount of efficiencies out there. Yes, that be the case, we can always say that, look, we are talking of one way in which the let's say transactions are happening and efficiencies are being created is based on market-based governance that is there. And you would agree that corporate governance is essentially merely a subset of this. That is the price formation. The expectation is there will be enough amount of, or infinite amount of market participants, leading to large amount of exchange between demand supply, That is the people having demand and people having supply issues and price formation happening. And there is that particular sense that perhaps the price formation there is more appropriate. On the other hand, if we take a look at what is the other part of the continuum, which is what I call as the state administered governance, or what we call as public governance. State administered governance. And in other words, what we are trying to say is, if you observe state administered governance, this is typically hierarchical in nature. So you would typically have somebody at the top directing the other party, and the other party directing the other party, and essentially they are expecting that these hierarchies, which are driven by public administrators, would ensure that governance takes place and there are efficiencies that get created. However, the literature in some sense has not focused on fair chunk of what I call as governance that is in the middle. So to give you some examples of it, we can have on one side collaborative governance. On the other side here, we could think of mandated coordinated governance. And you would agree that there will be a fair chunk of many of these things are also network-driven governances. Of course, while network does become part of many of these, but so to give you an example, let's say the Brahma Kumaris. It's a purely community-based network governance, and I'm sure there are transactions that are happening and that are not being captured by the economic indicators, which in an ideal context we would like them to be captured. Or the cooperatives of the world, some of those what I call as informal cooperatives of the world, such as let's say the cooperatives which are driven by communities, community-based governance. For example, one community helping out all the members of members of the community helping each other out in a very informal fashion, wherein they do not let the market kind of know the transactions that are there and they are supporting each other. You would agree that some communities, even after opening up of the markets, have only increased in their size and presence out there. And that's only feasible when communities do support each other. And that's a fantastic example of community-based governance out there. So what we are essentially trying to say is, and what can be an example of mandated coordinated governance, any organization which is semi-state or which is probably driven by some amount of state influence. So MPEDA, let's say Marine Promotion Export Development Association, wherein most, I think nearly 3 to 5% of India's exports of shrimps and aquaculture are largely, which is essentially India's aqua exports are largely governed by them. So you would agree that perhaps misses it is not being captured by some of these indicators which we've just discussed about. Similarly, when it comes to collaborative governance, you can think of those JFM, that is joint forest measures that are created, wherein the tribals are in some sense taken into account and they are consulted and there are actions taking place out there. So what we are essentially saying is decoupling is taking place, one, because of public debt not being visible in India, number one. Number two, a fair portion of what we can call as informal economy not getting captured in these indicators. Number three, of course, we already pointed out that the indicator itself is not present, which is what typical traditional economic indicators were. But there is a fair amount of future-based discounting that seems to be happening. And then as we move further, you would agree that there is also going to be this corporate ownership continuum issues. What do we mean by that? We mean that, for example, you can have, we just focused on two types of holders. One is the debt, the one who is giving debt, and then there is the one who probably is taking the residual portion of the ownership, which is essentially the focused on the residual benefits, that is essentially the equity holder. you would agree that in any organization, there are many other stakeholders and some having portions of this and portions of this also. And what we are essentially trying to say is we are also delving on the fact that cash flow benefits and control benefits could also be differentiated. And in that sense, while I may get cash flow benefits, which is largely a case of present, but if control is with someone else, then relatively speaking, the future orientation of these future cash flow benefits could be queued there, or it also can be, relatively speaking, leading to what we can call as issues of tunneling or private rent seeking and aspects such as those. Which some of these stakeholder engagements, which some of the, let's say, many of the formal BSE Sensex and NSE Nifty constraints, I'm sure we may be aware of. There are enough examples out there in the past, and I'm sure there are 1 to 2 forthcoming examples also, which some of us might be able to look at and take care of. So what we are essentially saying, trying to say is there are also issues of distribution. Then there are social capital driven biases that are there. I'll expand on this. Before I expand on this, let me elaborate on what are those corporate ownership continuum that essentially I was delving upon. If you observe, there are, while the Western world, which is guided by largely only these kind of firms to a certain extent, in a world such as India, you have firms such as Torrent, which are here, not just firms such as ITC, but there are also other 7 type of firms which are there. And so a Tata Motors might very well fit into this. And let's say there are, of course, there are firms such as, let's say, there are enough examples of pyramidal and cross-holding combinations out there, such as the Bajaj or the RPG group. So the Williamsons of the world could come here. Williamsons of the world could come here. And there are, of course, certain amount of tin plate kind of firms. Some of the select Tata group companies could come here. So what we are essentially saying is there is a fair amount of decoupling happening because of the firm type, simply for the fact that the nation's constitution of number 1 is hardly 20%. Concentrated ownership, to the rest essentially are 80% ownership of the world out there in terms of the listed entities that are there. If that be the case, we are also seeing that these organizations, what we call as future cash flows, or we can say the ownership claims in future, are themselves relatively speaking unclear. Relatively speaking unclear. Only this category of shares, that is organizations which are issuing these kind of shares, there is a implicit, you can say, clarity out there that they are clearly saying you guys have no voting rights. Let's say someone is going ahead and taking up a few GDRs or ADRs. There is a implicit, you can say, signaling that you are part and parcel of non-ownership shares, or whatever we vote as management, you will also vote in sync with us. Whereas you would agree that number 4 and 5, that part is also relatively speaking not clear. Neither it is documented as well, and nor people who are picking them up are aware of what probably are the ramifications of it. To that extent that it also leads to what we call as, there is this popular word saying, in Bombay, when you go, they often say there is a Tata discount out there. What it means is essentially, you will typically see TCS, other indicators being seen, the P ratio of TCS would be, relatively speaking, having a discount of 10 to 15% compared to Infosys and Wipro. I'm saying other things remaining same, of course, relatively speaking. So why is that so? Simply because there are perceptions of future cash flows because of lack of control There are perceptions that these pyramidal and cross holdings that are there might lead to future benefits being channeled to some other parties, or it could also be a case of what we call as like Vedanta, which recently tried to do. And I'm sure there are many other firms which have tried to do, which essentially might lead to what we can call as channeling of benefits out there, which might happen. So genuine benefits, which were probably created based on one certain proposition and assumption, suddenly getting into the hands of someone else. Now, what we are also trying to say is, to a certain extent, these issues are coming because many of these owners, for example, someone who owns shares of Tin Plate is a subsidiary of Tata Steel is a subsidiary of some other thing. The amount of power they have, the amount of legitimacy they have, the amount of urgency they have, there is a distinctly going to be some aspect disconnected. Now, if I were an equity owner and if I were a promoter, I would have power, I would have legitimacy, I would have urgency. But imagine if I were a GDR holder, or if I were holding some shares of a pyramidal company like Tin Plate, then you would agree that I will not have any own power here. I will have legitimacy and urgency only. So Michel's framework, there is this very popular stakeholder engagement framework known as Michel's framework, which essentially tries to say that, look, there are 8 type of stakeholders that are there, and we only, the equity owners by default, we assume them to be having all the 3 aspects: power, legitimacy, and urgency. In reality, that need not be the case. That is, the one in the middle, we call them as definitive stakeholders. And to a certain extent, decoupling happens as these, what we call as these corporate ownership continuum issues keep on increasing. Then what we are also trying to say is that while there are governance continuum issues, see, we started by saying the type of ownership, then we said market-based ownership, wherein we said, look, there is something which Post said, then Williamson proposed, which was then modified by Jones in 1997. And then there have been a few authors which tried to, I think, Elinor Ostrom was the Nobel Prize winner in 2007 or 8, essentially tried to interpret it from by studying the NGOs and saying that, look, there is another community-based governance which is visible. I am also saying there is community-based governance even within business, which is essentially the formal nature of it. To give you a very simple example, you will see that some communities are 100% dominating certain sectors. And there is definitely certain amount of community governance which is leading to this kind of, you can say, issue out there. So while we are talking about all these issues, what are the implications? Implications are something on the following lines. If we observe, this is something which I kind of created just about 2 days back, is the current indicator of stock exchange is saying, look, 40% of India's economy is financial sector, 3% is only automobile sector, 13% is the oil and gas sector, 20% is the IT services sector. You would agree that far from the reality that is there. It actually reflects biases because of the way these you can say index-based constraints have been picked, and using, of course, they while they do say that, look, we've decided on what is the maximum free float and how much trading happens, but as our discussion just now pointed out, free float first in itself is not an indicator of true ownership. We have been pointing that out. Second, we said, look, while you say there is market-based governance, in reality, it is not purely market-based governance. There is enough amount of network governances and other type of governances which are there. And we are also saying that all of this leads to systemic issues, both internally and externally. What do we mean by that? We essentially are trying to say that, just a minute, please. we essentially are trying to say that, for example, the world of ETFs and the world of trading that happens out there based on, for example, you have stock exchanges like NSE promoting, and you have these people like Lata Venkatesh of the world of CNBC channel promoting ETFs. Aren't they aware that there is clear-cut case of decoupling that is there? And then there is a large chunk of money which gets parked into India from institutional investors and the funds that are there from abroad. They are also getting trapped into these kind of what I call as the implications of these decouplings which are being created out there. So there are there. What are the biases? The biases are, first and foremost, it will only promote more and more of survivorship bias. That is the implicit assumption being, if you everyone would like to be part of this club of 30 or 50 firms. So only the firms which are surviving and which have been in some sense carrying on being part of this particular certain club will be only getting the benefits of it. Then the other thing is essentially what we call as, given that people more and more use a combination of SIP plus ETF combination, it could lead to what we call as a sunk cost fallacy out there. Since you have already invested, you start tending to feel that the it's like the too big to fail kind of syndromes also can happen. It will also lead to what we call as a groupthink bias. These indicators could also lead to a certain amount of groupthink bias. And it also leads to what we call as certain, if you only talk of these firms and everyday talk of their ticker tape kind of behavior, it also leads to a certain amount of confirmation bias. Then what happens is, the most important thing which I can say with confidence is the way the corporates also start behaving and playing to the tunes of the institutional investors and the constituents, the people who matter in terms of deciding on whether to invest or not. Let's say companies such as Infosys, Asian Paints, it also leads to a reciprocity bias. That is, you start doing things which you earlier never even intended to do simply because you are part and parcel of this certain club. And then what happens is, as I was pointing out earlier, it also leads to social capital driven based biases. Imagine an index crashing, the government will immediately intervene after, let's say, it crashes by a certain percentage point. Imagine a certain kind of sector which we just mentioned, one of those community based governance or some other based governance based economy crashing, government need not even take care of it. So there is a certain illusion of control also which is getting created by this. And what also happens is, it also creates what we call as an availability bias. That is, slowly people also start forgetting that there is this rest of the world wherein one can park their money as well. It leads to rest of the world, that is, it leads to those kind of issues as well. So these are the some of the, you can say, good and bad aspects of these decouplings which essentially happen that are there. What is the way ahead? How do we kind of ensure that some of these decoupling issues can get mitigated? First and foremost issue is, it is not something which can be done away with. You can only mitigate, but you cannot say that I'll make this decoupling zero. That's a very theoretical construct. That real economy can be reflected in a unique one or two indicators which the economy is providing, like NSE Nifty or BSE Sensex or something like that. One option is for the state to move towards valorizing a more broader indices. At least to that extent, what will happen is, it will be more representative of the economy in itself. Second is, find out ways and means to capture the social, that is the organizations whose governance is not pure market based and neither purely state administered, which are somewhere in the middle, let's say through social stock exchange. Already there have been enough moves by the government to move towards them. Fourth, find out ways and means that the other stakeholders and their ownership that has been their kind of stake, their money which has been there, find out ways and means on how we can capture and get them measured out there. While having private debt and only depending on that is fine, but you would agree that somewhere we also need a debt based indicator which captures how the economy is doing from the perspective of the lenders out there. And of course, this always remains the theme which you will always see in almost all discussions is find out ways and means of converging the informal to formal sectors out there. While these are some of the thoughts which I am sharing as part of our discussion, I'm sure there are people who probably know a far more, and I'll be happy to take their inputs, insights, questions, and see how we can welcome them or capture them in this particular discussion. The floor is open for questions.
Professor Ram, thank you for your enlightening lecture. Just I have three observations on this. One is this